Good afternoon, ladies and gentlemen. My name is Michalis, and I'm one of the market analysts here at HF Markets, and I'd like to welcome everybody to another webinar. Today, we're going to be looking at placing orders, different types of orders, and we're going to be looking at stop loss trailing stops. And there's a specific reason why we're looking at this topic today. So over the past month, we've looked at two specific trading strategies. We've looked at specific techniques, specific indicators, and how we can merge these to create an all-round strategy. Very easy strategies that we've looked at over the past month, something that anybody can use as soon as watching the webinars. But we had certain questions that kept reoccurring. The most popular question is, yes, I understand that we have a certain checklist, we have certain requirements in order to get a signal materializing. If a signal does materialize, then we can trade. We knew what price it was going to materialize, we knew most likely what time, and so on and so forth. But the question was, how can I ensure that I'm not going to miss that opportunity? People used to say, they had a lot of individuals saying, yes, I understand this is the price that we're looking for, this is how much price movement we're looking for in order to get a signal, but I can't sit in front of my computer the whole day and wait for that to happen. So a lot of people, they commented, they said they tried the strategy, it's a very helpful strategy, massively helped their success rate, but they found that a lot of opportunities were missed when they weren't looking at the mobile app or the MT5 and so on and so forth. So today we're going to be looking at different types of orders, because there's certain orders when somebody is looking at a strategy, they know what type of indicator is about to develop because they've already done their certain checks. They know what price they want to trade at, what direction they want to trade at, and so on and so forth. It's just about ensuring that they take advantage of that indicator, indication, and price movement. So this is why we're looking today at pending orders and different types of orders within the market, not just pending orders, but we're going to look at other orders as well. The other most popular question, ladies and gentlemen, was very simply, great, it's a great strategy, but how far away can I put my stop loss? How much can I earn per trade for using the strategy? So where am I placing my stop loss, my take profit, trailing stops? And again, we're going to be looking at other types of orders and tools you can use in the market. So this is why we're looking at today's strategy, because we had a lot of questions, and it's great that we get amazing feedback from the strategy, and people that are testing it and using it, they're giving us a lot of great feedback. But what's also better is that they're coming with, yes, the good feedback, but also questions on how to ensure that they're using the strategy appropriately. So two things that we've had reoccur over the past month. Number one, using the strategy, where should we potentially consider placing our stop loss, our take profits? And in addition to this, how can we use certain orders within the market to ensure that we're not going to miss this price movement? Today's subject is a very basic subject. The webinar is going to be approximately 50 minutes. And like I said, it's a very basic subject. Even somebody that's very new to the market and has only been trading for a couple of weeks, this is a great opportunity where they can really enhance their knowledge of what's available to them from the platform, because it's not just buy, sell, and you've got to sit in front of your computer all day. There's a lot of things that people can use in order to help them trade the financial trading markets. So this is what we're going to be looking at as part of today's webinar. Before we look at that, very quickly, I want everybody to be aware, because people have known me a very long time, because I've been in the industry for 10 years, actually, just over 10 years. 4 of those 10 years, I was a financial advisor in London. But these webinars, they're not here to give you financial advice. It's not here to say, yes, you as an individual, you should be placing these trades and so on and so forth. We're not here to give financial advice, but what we do want to do as part of these sessions is to give you as much educational material as possible in order for you to be trading within the financial trading market with knowledge, with experience, and with expertise and confidence as well. in order for you, of course, to have a better possibility of achieving your targets. So I want everybody to be aware that, of course, these sessions are here for educational purposes. The only thing, in addition to that I want to mention as well, is yes, we're looking at a presentation. There's actually two types of webinars we normally do. We normally do either one which is based on presentations or another one which is based on live analysis. So we look at we analyze the market together live. We look at where there's signals, what directions these signals are indicating, potential stop losses, take profits. So we actually look at the market live together. So these sessions are amazing. The other types that we do are, for example, these webinars where we have presentations and it's more educational. Either way, I want people to, feel comfortable asking me questions. This isn't a seminar where we sit back, we've got our book, and we've got our pen, we make notes, and that's the end of it. There is an option on the GoToWebinar software where you can ask as many questions as you like. Write your question down. I won't expose any sensitive information such as your name and where you're from and your email address, etc. Very simply, I will read the question out. I will answer the question and we'll look at it together to make sure that you fully understand and feel comfortable with that aspect of the market that you're inquiring about. Now, I don't want to spend too much time as part of this slide. It's not important. It's not going to make you a successful trader. But I do think it is a little bit important to know some information about the individual who's providing you with this presentation. So like I said, I've been in the market just over 10 years. Originally, I was in London as a financial advisor. That was for about 4 years. People should know that I'm a licensed financial advisor in the UK and in CySEC as well, which is a European regulator. But again, I don't want to spend too much as part of that slide, to be honest with you. Now, at the end of every single webinar, we always have a poll. We actually have a poll. We will have multiple polls throughout the webinar. But at the end of the webinar, I will ask a question about what everybody believes is going to happen to one of the assets. Last week, we looked at the NASDAQ, and we basically said, the question was, do you believe that the NASDAQ will end the week higher than 17,650? The price at that time was at 17,438. So you can see there's a very big difference here, ladies and gentlemen. The vote 100% of the people that voted advised that they do believe it will increase from this price to this price by the end of the week. Now, after the webinar was on Wednesday, so between Wednesday all the way up to Friday evening, the price increased to a high of 17,778. By the end of the week, it ended the week by 17,714. So we're looking at 0.73% higher. If we're looking at the high, we're looking at 0.36% higher if we're looking at the end. The current price actually is lower because we had certain crashes over the past, especially on Tuesday and over the past few days. Why? Because we've had a very hawkish central bank, Federal Reserve. We had a lot of economic data indicating that they were going to become slightly more hawkish in terms of their stance. We had a lot of economists actually come out and say, we no longer believe that the Federal Reserve is going to even cut interest rates by 3 times this year and by 0.75%. We actually believe it could be as low as only on one occasion. So if that is the scenario, the market was extremely wrongly priced. And that's why we got that significant collapse. But very quickly, a thumbs up to everybody. Everybody voted that the NASDAQ would end the week higher than 17,650. Everybody was correct. Hopefully, people didn't just answer that on the poll, but they traded it. And I say hopefully because they would have taken advantage of it. It would have been a great trade for them. But today we will have another poll. Today we're going to ask everybody what they think is going to happen to gold. Last week though, great job guys, because you had you're 100% correct. No, 100% of people said it would increase that level. It did increase that level. Nobody was incorrect. Hopefully, some people took advantage of that as well. I say hopefully because on that occasion, everybody was right. So there's two types of orders within the market. Now, what I want people to understand is because people get the wrong idea about how assets are priced. Because it's always good to educate yourself. People go on YouTube, they look at different educators, and educators will always say the asset is priced based on supply and demand. To a certain extent, that is correct, but really it is incorrect. And I'll explain exactly why. Supply and demand, an asset can be priced on supply and demand. So for example, clothes are based on supply and demand. Food is based on supply and demand. So they say, this is how much supply we have. This is how much we're willing to sell it. As long as people are willing to buy at that level, we're going to keep it at that level or consider increasing it. So it's supply and demand. But when you're looking at the financial trading market, it is based not on supply and demand, but it's based on what is known as the order flow theory. Now, what is the order flow theory? When you go to buy something in the stores, there's a price. If it's available, you buy it, and that's the end of the story. Now, when you're looking to buy a stock or to sell a stock, or it could be commodities, it could be currencies, whatever it may be, you place an order. So it's like when you go to a restaurant and you say, I wish to order this meal. Now that meal may be available, it may not be available. So if somebody is a shareholder, so for example, a stock which that has done very well this year is Alphabet. According to the price to earnings ratio, Alphabet is potentially the best valued stock according to that ratio. So let's say I'm a shareholder of Alphabet. If I want to sell out my shares, I don't necessarily just go and I sell it and somebody's instantly going to buy it. I place an order to sell it. Now, if somebody's not there to buy it, that order will not be filled. So what happens is when there's a lot of sellers, but there's not enough buyers. So let's say, for example, there could be 10,000 sellers and 1,000 buyers. The price will decline. Okay, and as the price declines, the idea is the lower the price will become, the more buyers which will be enticed and the more individuals which will be prompted to make the investment. So as the sell orders reach up to here, the price will continue to decline until those orders can be fulfilled. Okay, so for example, you may place an order. Let's say I'm a shareholder. And the price of the share is 150. I may click on my computer to sell at 150, but actually the price that I'll get potentially maybe 147. This is actually what is known as slippage, ladies and gentlemen, because nobody is willing, or there's not enough individuals willing to buy at 150. So even though I placed the order at 150, the transaction is completed at 107 and 147. So there's $3 slippage. Now, why am I saying this? Number one, it's important for you to understand that an asset is not based on supply and demand. An asset is based on orders. And when you're looking at institutions and more advanced traders, we're not going to be looking at it today because it's very advanced. They analyze the price based on what is known as order flow analysis. So that's definitely something everybody needs to write down. Order flow analysis. But the reason I mention this, ladies and gentlemen, is because people also need to be aware that there's two types of orders within the market, which are going to influence the price as well. Now, the first type of order is pending orders. Now, pending orders is when you're not instantly entering a buy or a sell, but instead you are ordering the platform and showing interest to speculate a direction of the market at a specific price. So for example, if we're looking at a stock, let's get my pen out, there we go. If we're looking at a stock, ladies and gentlemen, the stock price may be doing something like this. The price at the moment is here. Now, if I want to enter now, I have to enter at that price. If I don't want to enter at that price, if I maybe think that that price is undervalued or overvalued, whatever it may be, but let's say I don't want to place an order at that price. This, let's say, is at $100. Instead, I want to place my order at $110 because that's why I believe the price will be overbought. That's why I believe it's going to be more expensive. So what I do is I place a pending order. So it's an order which is basically saying to the market that if the price increases to that level, I want you to place an order to speculate a specific direction in the market, whatever that direction may be. But what is a pending order? A pending order is when you state to the platform that if the price goes to this level, I want you to either speculate an increase or a decrease, or both potentially as well. Maybe if you've got individuals looking at hedging, reverting market conditions, and so on and so forth, in which case they can take advantage of opening both directions. So it's not an order where you place the order and you instantly enter in the market, just saying to the platform that if the price may never go there, in which case the trade is never going to enter, but if the price increases to a certain level, please place either buy or sell trade. So this is a pending order. Then you've got a market order. A market order is when you place an order to either buy or sell an asset at a chosen price, and it will enter the trade. And again, doesn't mean it's going to enter at that specific price, but it will enter the trade at the closest possible price. Now, somebody is going to say to me, and again, there's a reason why we mentioned the order flow theory. So a lot of people throughout webinars, they say to me, I entered at this price, but it opened a couple of cents higher. Why is that? Of course, one scenario is, of course, the spread, definitely is a spread. But in addition to that, you have to take into consideration the price is based on order flow as a theory, in which case, yes, you're placing an order at that level, but is it available at that level? Yes, you want to buy the stock at $100, but is there somebody there willing to sell it to you at $100? If not, then maybe you have to buy at a more expensive price. If you're placing a market order, it will enter at the best appropriate and closest price. And again, if there's a difference between what you're ordering and what you're entering, this is known as slippage. Okay, so what we're doing as part of today's webinar, like I said, what we want to do is understand all these different types of orders so we can look at how to take advantage of them while we are trading. Because we've looked at two different strategies. We've looked at them in a lot of detail over the past month, but how can we use pending orders to ensure that our target is achieved and we are cashing in on the target rather than missing it, that if there's an opportunity, we can take advantage of it. And at the same time, we are mitigating the risk. So we are controlling the risk as well. So I've got a question here. Let me quickly read this question. So somebody says, can you also have slippage when it's not stocks? Yes, you can have slippage on any financial trading asset because it's still based on placing orders. It's not something physically, you know, if you go to the store and there's something physical there in front of you, and there's not thousands of millions of people bidding for it, it's something, of course, there's no slippage. There's price, you pick it up, you go to the till and the cashier, and you pay for it, and that's the price you're going to pay. There's no slippage. When you're looking at the financial trading markets, because it's priced based on orders, it's very similar to an auction, and there's millions of people bidding and trying to buy and sell, then of course there is slippage which is going to apply. So within the financial trading market, yes, there is slippage, not only for the stock market. So orders, let's look at each order. Now that may look like a lot of different types of orders. You're going to have access to the recording of this. You can re-look at this. You can take a screenshot. You can take a picture. It's completely down to you. But we're going to look at these throughout the next slides as well. So the first thing, take profit. People said to me, because we were looking at this month, trades based on trends. Next week, we're going to change the theme and move away from trends, because 2 months ago we looked at reverting market conditions. Last month we looked at trends. Next week we're going to look at news, and we're going to start to concentrate on news, things to be cautious about, how you can take advantage of news and things like this. So there's always a reoccurring theme, because you can't learn everything necessarily within one single webinar. So take profit. Okay, this is the first order that we're going to take into consideration. It's very easy to understand. I don't want to complicate it. It's a trade which could be in either direction, which you have preset. So you predetermine the price which you want the trade to automatically exit and cash in the profit. Okay, what do I mean by cash in the profit? Let's say, for example, you're looking at an upward trend. Let's say it's like this. You enter a buy here, but you place a take profit here. You traded, let's say, $100. At this price here, the profit will be $125. Now, if the price continues to increase, and it increases to your take profit, it will close the trade. It will put the $100 back into your trading account, plus the $25 as well. So it's a preset price, right, that you attach to your trade, and you're saying to the platform that this is the price I want you to exit my trade, and it will automatically exit the trade, whether you're asleep, you're on your computer or not. Even if you've got no access to the internet, it will automatically exit your trade. This is known as a take profit, and it's in relation to profit. Very simple. Now, let's say we're looking at the same scenario. We're looking at, an upward trend. We're placing $100. That's my exposure, for example. Our target is 125. This is our take profit. So I've opened the trade, and I've set within the trade a take profit, saying if it increases to that level, exit the market, to ensure that I'm benefiting from that increase, and I'm benefiting and able to, should we say, have concrete profit. Okay, because if you've not closed the trade, that profit's not concrete. There's volatility. The price may start moving against you, in which case, depends how much it's going to move against you. You may lose a percentage of that $25 that you've earned. Now, take a stop loss. A stop loss is a trade which is closed again at a predetermined price. So you determine the price that it's going to close, but it's not relating to profit, but it's related to the loss. So, for example, I've opened the trade at $100. For example, at $90. Okay, this is where I'm going to put my stop loss. So if the price doesn't increase, my analysis was incorrect and it doesn't increase, and the price actually does something like this, as soon as it closes, as soon as it hits that price, it will close the trade automatically, and it will take that $90 and put it back into my trading account, guaranteed. Okay, so this is a stop loss. Now, what I will say is a stop loss doesn't move, and a take profit again doesn't move. You set a price and it will stay at that level. And there's a reason why I'm saying this. The next thing that we're going to look at is a trailing stop. A trailing stop can be related to protecting against larger losses, or it can be related to protecting the profits which you have earned. Okay, but you haven't closed the trade. So like a take profit, you earn the profit, you close the trade, and that profit is concrete, it's guaranteed. The trailing stop is when you're not closing the trade, but it's still protecting a percentage of your profit to a certain level. There is certain scenarios that it may not. I'll explain where potentially it may not. So for example, a trailing stop, again, let's say we've got price movement like this. I'm placing a buy here, okay? And my trailing stop, I'm not setting it at a certain price, like a stop loss and take profit. What I'm saying is, I want the stop to always be 5% below the current price. So if the price increases by, let's say, 20%, okay, let's say it increases to this level is 20% higher, my trailing stop will be here at 15%, plus 15%. So as the price increases, it will continue to increase along with the higher price. So it's a certain percentage below the current price. The price increases, the trailing stop will increase with it. If the price decreases, the trailing stop will not decrease. So for example, we're placing the trailing stop 5% below, and you've got options in terms of how it's going to be priced. You may say, I want it to always be 5% below the current price. You may say, I want it to be $5 below the current price. It could be certain units, certain pips, certain pipettes. It's up to you how you're going to set it. A lot of people put it as certain pips, for example. So at the moment, I've got it 5% below the current price. If the price never increases and it just declines like this straight away, it's never going to move. It will stay at 5% below the current price, in which case it's the exact same as a stop loss. There's no difference. Let's say if the price increases here by 5%, okay, my trailing stop will go to this price, okay? Let's say it doesn't increase any further though, and I haven't closed the trade, and the price does something like this. It will close the trade here. So again, as the price increases, it will increase with it, but as it declines, it will not decline with it. So for example, in this scenario here, you would have closed the trade at a take profit. Sorry, you would have closed the trade at a break even, neither a loss or neither a profit. But if you're, let's say, 50% higher and you've got 50% profit, and you put in a trailing stop 5% below, then of course you're protecting 45% of your profit that you've earned. So this is a trailing stop, a very interesting tool, slightly more advanced than the stop loss and take profit. The only way that a trailing stop, same way as a stop loss as well, isn't guaranteed is if there's a price gap within the market. So for example, if let's say we're trading oil, which is very volatile and related to geopolitical tensions as well, we could say, for example, let's say Friday's a great day, really strong upward price movement. Everybody's taking advantage of it. I'm going to take advantage of it as well. I place a buy here. The price increases like this. So I'm in a profit. I haven't closed it. I should have closed it, but let's say I haven't closed it. And let's say I'm putting my stop loss, for example, here at this level here. Okay. The market closes. Okay. So over the weekend here, there's no price movement, just a gray shaded area. Over the weekend though, let's say Ukraine and Russia and that conflict comes to a peace agreement. At the same time, should we say Palestine and Israel again come to a peace agreement, and so on and so forth. So this is something which is, should we say, definitely positive for the world, then it's positive for stocks. Stock market, it's positive for a lot of things in the market, but it's negative for the price of oil because it's significantly lower risk and people aren't willing to buy as much because of the lower risk. So the price actually may open down here, in which case it's below your stop loss or below your trailing stop. So it's not going to close at your stop loss because the price was never there. Okay. What it will do again is close at the best appropriate available price. And again, if we go back, this is the reason, ladies and gentlemen, why I'm mentioning that the price and assets are based on orders. They're not based on supply and demand. Here, ladies and gentlemen, with oil, the supply hasn't changed. The demand hasn't changed. Everybody's still using it. The only difference is people are not placing orders. Okay, people are not placing orders to buy anymore, and because of that, it's creating a price gap. So this is a good example. Moving on, stop orders. Okay, stop orders and limit orders are pending orders. Okay, so if we go back a slide, there's pending orders. Pending orders when you don't instantly enter into the market. You're basically saying at this certain price, I want to enter the market, but it's not a price that we're currently at the moment, so I cannot enter at the moment. I place a pending order. So if it reaches that level, you enter into the buy and sell. And there's two main types of pending orders. You have the stop orders and you have the limit orders. And we're going to look at how we can use this as part of our strategy that we've looked at over the past month. Again, because we've had such great feedback, especially with the success rate and how the success rate has significantly improved. But a lot of people have said sometimes they miss opportunity. How can they stop missing these opportunities? And the scenario is pending orders. Sorry, the solution is pending orders. So you've got buy stop and sell stop. This is normally when you're trading in the direction of the trend. Not always, but normally this is the scenario. So if we've got individuals, and most individuals in the latest poll that we did actually showed that they want to take advantage of the trend and not get sucked into that, should we say, those bad habits of as soon as the price increases, try and speculate the decline. As soon as the price declines, try and speculate the price increase. And then you get sucked into fighting the trend. And if you're going to fight the trend, it's very difficult to profit from it, especially if the trend keeps on lasting. For example, the NASDAQ, anybody that was fighting the trend in the past 18 months, it's going to be very unhappy. So there's, of course, benefits to trading the trend, but how can we take advantage of that? Buy stops, sell stops normally are when we're trading the trend. So buy stop is when you're buying above the current price. So let's say, for example, the price looks something like this. You're saying if the price increases to this level and is above the price, to buy. Okay, so you're saying here, I want to speculate upward price movement. This is a buy stop. Why? Because it's not at the current price, it's above the price that you're saying, and you're speculating an increase, which is a buy. So for example, the pending order may be at 120 for the stock to buy at that level, whereas currently we're at 110, for example. Then you've got sell stop, which is basically a price down here, in which case if the price does something like this, at this level, you're going to speculate a price decline, ladies and gentlemen. This is a sell stop. Why? Because it's below the price, you're trading in the direction of the trend, and it's a sell, so you're speculating downward price movement. Then, ladies and gentlemen, you have limit orders, which are again pending orders. But this is when you're trading against the trend. A good example is basically reverting price conditions. Anybody using mean reversion, this is a good example here. So again, if we look at price movement like this, a buy limit is when you're buying below the price. So the price is declining, so the trend is downwards, but here you actually speculate that the price is going to increase. So you're actually speculating against the trend. It could be because you believe it's a reverting price condition. You may be thinking that a retracement is going to form temporary or correction, and you want to take advantage of that. Again, you've got buy limits which are available to you. Then you've got sell limits. So it's when it's above the price. So if the price increases to here like it has, you can speculate the downward price movement. Again, it's against the trend because the price movement's upwards and you're speculating that it's going to decline. Again, like we've looked at on previous webinars, there is risks to that because you're trading against the trend. Okay, so unless you're certain the trend is going to end, it's not good enough to necessarily say it's overpriced. It has to come down at some point. It doesn't. You know, if people keep on buying, it will keep on increasing. So you can get sucked up into those bad habits, into that emotions of, you know, trading with those emotions. But there's advantages to waiting for there to be something concrete before doing so. Let's very quickly do a poll, ladies and gentlemen. Let's launch this poll. Very, very quickly. I won't allow a long time for people to answer. So we've mentioned reverting market conditions. So what is reverting conditions, which is also known as reversion? Is it a trending market? Is it when the price corrects back to the average price? Is it when the price declines? Is it when the price is unable to form a lasting trend? Nobody's voted yet, so I think people don't know the answer to the question. No, okay, so people are starting to vote. We've got people voting something completely different, actually, a lot of the time. So we've got somebody that's voted every single option as well. So this is good, because this is why we do polls, so we can actually correct things. Okay, so let's end the poll there, because we've been, I can see 56% of people have answered it. So the correct answer, ladies and gentlemen, is actually when the price corrects back to the average price. But the price, and also 63% answered that answer. But what am I going to say? The price can be retracing back to the average price, but still be in a trend. So you can be looking at reverting price conditions, even though you're looking at a trending market. It's just that there is retracements, and the retracements are large enough to go back to the average price. But of course, as the price keeps on increasing, that average price also keeps on increasing. So it could still be a trending market. The price can still be declining. We can still be looking at a bearish trend, but the price is correcting and reverting back to the average price. So let's start looking at our strategy. We looked at two strategies this month. This one is the one that we got the most feedback. We actually didn't get anybody come back and say, you know, this didn't work for me, because there is certain strategies. Doesn't mean the strategy is wrong, because all strategies that we look at, they're well-known strategies within the market. It's not just a strategy which I have designed. I'm not that clever. You know, as a financial advisor, it's things which I learned from trading floors, from institutions, from my licenses, and so on and so forth. It's not that I've got a PhD and I invented something new. But certain strategies don't work for certain people, because people have different approaches. It's nothing bad. So for example, I may be an ultra short-term trader, but if I'm using a swing trading strategy, it's not going to work. But this, we had a lot of feedback. We looked at a 2-hour time frame first, and then we looked at this time frame. This is a 5-minute time frame. We're not going to look at the 2-hour. We'll look at a different example where we'll look at both. But what are we looking at? We looked at the 2-hour, and we wanted to establish on the 2-hour that buyers are controlling the market, and that there's bullish sentiment towards the price from investors. This is what we wanted to establish. After establishing that, we go onto the 5-minute chart like so, and we wait for at least one impulse wave. So if the price is declining like this, and then we get one impulse wave like this, we don't look to take advantage of that impulse wave. We wait for a retracement, and then we look to take advantage of the second, third, fourth impulse wave. After the fourth, we start to come into danger of becoming overbought. So you need to be cautious of that. But definitely the second and third, a lot of advantages to that. But we avoid this first, because we don't know necessarily if the first is going to increase to here and find the resistance, if it's just a one-time correction, and so on and so forth. So we want to establish buyers are controlling the market. We wait for that impulse wave and then trade the continuation of the trend. Because once the trend is formed and you're trading just a continuation, half the work is done for you, because you've already established it's a trend. It's just about making sure the timing is correct. Whereas if you want to trade the first impulse wave, you actually are trading before the trend is established. So you have to be able to predetermine how the market is likely to move. And if you do that, there's a risk of trading against the trend. Being sucked into trading against the trend. So we saw the impulse wave. You can see that upward price movement here on the bottom left. But we wait for the retracement. Now, as the retracement formed, let's get rid of that. As the retracement formed, we can see the price increased to here and continue to decline all the way down to here. So this is a retracement. We have to ensure it is a retracement. And it is because this is the low and it didn't decrease to the previous low. And also, if you look at the previous high, this is the high, this is the next high. So it's a retracement for sure so far, because it is still a higher high and it's still a higher low. Whereas if it was a correction, I'd no longer look at it as a potential signal. So we look at the high and we look at the low and we draw the Fibonacci retracement levels. Based on the Fibonacci retracement levels, you can see here there's different numbers. 23, there's 38, there's 50, there's 100, there's 165, 261, and so on and so forth. What is the area for us? It's at 65. So what you're basically saying is that, you know, we've got this impulse wave, it's retraced. I believe it's going to continue to move upwards, but it's about getting the timing right. It's not just about saying, let's just enter a buy and at some point it's going to increase. It's about the timing and trading at the right price, not at the wrong price. So you're basically saying if it increases to here, then that's enough momentum for me to start to trade and take advantage of the upward price movement. And this is exactly what we're doing. The price has declined like this. I'm basically saying this is enough momentum in order for me to start speculating a price increase. So I've drawn a green line here at the 65 because it's at that level which I enter the buy. Now, where does pending orders come in? Okay, so we're looking at a buy stop. Why? Because a buy stop, ladies and gentlemen, is when you're trading in the direction of the trend. So the retracement has declined to here. Let's say this is where we are currently at. We're currently at this level here. I'm placing my buy stop here. Okay, I've already drawn the Fibonacci levels. I know that 65 is here. So I'm putting my buy stop as 1.06701. So if the price increases up to there, it will automatically instantly enter whether I'm on the computer or not. So I'm not going to miss that opportunity. It does increase up to there, ladies and gentlemen, and very simply we enter the buy here. It retraces slightly, not by much, it doesn't go near our stop loss. Where am I placing my stop loss? On this scenario, I'm placing it just below the 0 on the Fibonacci, so you can see I've placed my stop loss just below. You can see it doesn't go close to my stop loss. People may think it's close. There's enough margin there though, more than enough margin there. And you can see we entered here. The Fibonacci level has 165 here, so this is one target, and then we've got a second target here. We can look at scaling in and scaling out if we want to take advantage on multiple occasions. But you can see it hits this scenario and it hit this scenario again. Now, what I will say is, based on putting your stop loss there, volatility potentially can knock it out. It's not an issue to knock it out and close the trade on a very, very small minus, not an issue at all. So for example, the trade continues and here we get another retracement. So here you can see this is the high and this is the low. And then the price starts to increase. So I've taken this high and this low and I draw the Fibonacci levels again. Now, most likely, I probably would have had to have entered here based on that scenario. But my stop loss probably would have been about here. So you can see my stop loss would have been hit. It's not an issue though, okay? It would have been here, it would have exited my trade. It's not an issue. People, you know, they say, I want to stay in the trend. I don't want to exit it in the minus because the price may start to move in my favor. If it does, open another trade. You know, why risk losing the money? Okay, exit. So you're not going to lose excessive amounts of money. Exit, it's not an issue. We'll look at it, it's in our success rate and reward to risk ratio to make sure it's not an issue. And all you do, ladies and gentlemen, is you've exited the trade here, okay, for example, and the price has declined to here. So you draw a new Fibonacci level. So this is the high, this is the new low. So you draw the Fibonacci, and again, you probably would have entered into a buy here, okay, approximately. The price increased all the way up to here, okay. This is where the price increased. again, most likely that would have hit your take profit. People may say this is a 5-minute time frame, it's not that far away, but if you're using the 5-minute time frame to enter, of course you're looking at short-term trading. You want to enter and exit as soon as possible. So within the hour you want to exit. So you can see here how exactly I'm using pending orders to enter, and also using pending orders such as stop losses and take profits to ensure that I'm achieving my target. Then you've got, this is actually same strategy. So here I've got a 75-bar exponential moving average, which is here. So it's a moving average. Exponential is the method. We've got an RSI here, okay, which is on a period of 18. And what do we want to see? We want to see the price below the 75-bar exponential moving average, below the RSI 50. Okay, so here we can see just below, the price at the bottom is just below. We want to see below, okay? And we want to see a bearish candlestick as well. So the candlestick declining. We don't want to see a green candlestick. So for example, here we wouldn't trade because it's a bearish candlestick. We'll wait for the next, it's a bullish candlestick. We'll wait for the next bearish candlestick. So there's 3 things on our check, okay? Number 1, we're below the 75-bar exponential moving average, we're below the RSI 50, and we've got a bearish candlestick. Very simple. We've ticked all those boxes, so we now go on to 5 minutes. This is gold, by the way, ladies and gentlemen. And you can see 5-minute time frame, gold again. And we wait for the first impulse wave. We don't trade that. So this is the first impulse wave. We now have a lower low. We've got lower highs as well. Okay, so we can see it's definitely a trend. So it's not conflicting the picture that we were seeing on the 2-hour. The 2-hour indicated that sellers are controlling the market and there's bearish sentiment towards the assets. So this isn't conflicting it. So we wait for that impulse wave downwards, and then we wait for the retracement again. So here's the low, here's the high. I've drawn my Fibonacci levels, and I'm placing my pending order, okay, so that, because I may potentially be here, even as I'm on that level, I've placed my pending order, that if it declines to our 65 point on the Fibonacci, which is basically at 2,318, to enter a sell trade. So you would have instantly entered the sell trade. It never at any point moved upwards, so it didn't at any point go close to our stop loss. But again, I put my stop loss slightly above the 0.0. And you can see 0.65, 261 is the Fibonacci levels where I'm putting my take profits. So this is where I'm exiting the trade. Another thing for people to take into consideration, think about putting your stop loss where your analysis is proven that it was incorrect. Okay, so for example here, there's a reason again why I'm putting my stop loss just above the 0, because if it goes just above the 0, it's now gone to a higher high. Okay, and it's not a retracement, it's gone to a higher high. So there's potential there of there being a correction or a different trend. I don't want to risk that. It may not form a different trend, but what I do is I exit and wait for the next indication to take advantage of that, rather than keeping it open for hours and hours and days, and that loss just becomes larger and larger and larger. So what I will say on this chart is, when your analysis is incorrect, that's a good area where to potentially enter your stop loss. Okay, if you're not going to put a stop loss, there is a danger that there's a lot of volatility and it declines below a level that you are willing to close at, in which case you emotionally will struggle to close at that level. So this is a good example. This is the euro against Australian dollar. Let's say I bought here because I could see very strong upward price movement, started to increase again. So I thought it was going to go on to a higher high. Big mistake. So I put a stop loss just below the previous low, because I'm basically saying if it's gone to a lower low, then there's potential of the price declining. On that scenario, it did decline. It could have been, it doesn't decline, it declines temporarily and goes back up. Again, that's not an issue. You take advantage of the next indication. Now, this is the last thing I will mention, and then we'll do a poll as well. Where to put your stop loss, where to put your take profit, it is to do with the charts and your analysis, like we were looking at up to now. And again, there's a reason why we looked at stop loss, take profit, trailing stops, because you are enabling it as part of that strategy. Again, the pending orders. It's not about, you know, I've gone, if we go back to here, okay? Let's say we haven't seen this downward price movement yet. We're still up here and it's retracing upwards. I've drawn my Fibonacci. I know that I want to enter a sell at the 65 area. Because that's enough momentum in order for me to take advantage of the downward trend. Whereas if I wait for the breakout's here, okay? So if you had the option to trade the downward trend here, trade it slightly higher, of course you're gonna opt for the slightly higher area, which is a more competitive price. But instead of saying, you know, this is the price I want to enter, and you've got to sit and wait and wait and wait to see if the price declines there, you place your pending order, you place your sell stop, and you can take advantage of the trend using that. And again, you can attach your stop loss and take profit in accordance to that as well. Now, what else? Where to place your stop loss, take profit? You have to look at the statistics behind your trade. And I always look at this. I look at it pretty much on every single webinar because it's so important. It is so important, and a lot of people don't do this. You know, when you look at statistics, traders that are unsuccessful, they're unsuccessful because they allow trades to keep going and losses to keep going. So they go into a little bit of a profit, they close it. A little bit of a profit, they close it. And then a market moves against them, and they keep it open and keep it open, keep it open and keep it open. And it's either eaten away all of their profit or even more. That's not a scenario you want to look at. You want to be strict on your entries and exits. Strict, okay? Believe me, there's no bank, institution, there's no professional trader which isn't strict on this. So for example, let's say you're trading 15 trades a week. All of them you close, you're not keeping them open. And you've got 60% success rate. Your target is let's say your target is $10 to earn, and you're risking $15, so you've got a negative reward to risk ratio. Now, based on 60% and 15 trades, 9 trades you close in a profit, 6 trades you close in a loss. Now, for a beginner, that's not bad. 60% success rate is not bad for a beginner. But because you're risking more than what you're looking to earn, you got 90 and 90. So profit from profitable trades 90, loss from losing trades 90. So you're not in a profit. So what is the point? You don't have to wait for you to have a 95% success rate in order for you to be profitable. Slightly change it if possible. So you can see this scenario here. Still 15 trades, still 60% success rate, but I've upped my target. So my target per trade is 15 USD. My risk is 15 USD. This hasn't changed, but this has changed. So I've got 135 and 90. So now I've got a profit of $45 from this week. So you can see here how I'm looking at the mathematics behind my trades. I'm being very strict and not allowing a single cent more in terms of risk or more in terms of profit. I follow the mathematical plan to ensure that there's a strong possibility of, as long as I'm keeping to the success rate, of course, if my success rate suddenly changes, then of course it's not that scenario. But a good possibility of me trading with low risk, controlled risk, not low risk, controlled risk, and a higher possibility of achieving my target. Now, let's say, for example, because you don't just change it by yourself, you go onto the chart and you say, you know, if you're buying here, if you're selling here and closing the trade here, then yes, happy days. The price keeps moving in that direction. So if on those 9 trades that you were correct, you could have kept it open longer, then happy days. You can keep it open for longer. But if you can't, so for example, if it's an upward trend like this, you open here, your take profit is here, and the price only increased up to here, in which case actually you want to maybe put your stop loss, sorry, your take profit slightly closer. If it's a scenario like this and the price declines afterwards, you cannot put your take profit further away. But what you potentially can do is put your stop loss closer. So for example, here, my take profit is still 10 like it is here, okay? But what I'm doing is I'm changing my stop loss, okay? So you can see my stop loss is lower, but I'm still earning 90 and I'm still a profit here. So that's the end of today's webinar, ladies and gentlemen. We'll have a very last poll, the very, very, very last poll. This time is based on gold. So I will leave 1 minute if anybody wants to answer this poll. What do you think is going to happen to gold? Do you think, based on the current price, is the price of gold going to end the week higher or lower? Now, if somebody's wondering what the current price is, the current price of gold is 2,302. So do you believe it's going to be higher or lower? I will only allow another 30 more seconds. Higher or lower, ladies and gentlemen? Okay, so I can see 70% of people have voted. So let's close the poll. So we have 64% of individuals believe gold will end the week higher, 36% believe they will end the week lower. Okay, so in next week's webinar, we'll look at what happened to gold and if most people were correct or most people were incorrect. So let's end today's session, ladies and gentlemen, because we've also got a live analysis webinar on YouTube. So let's end very quickly so everybody can go to the live analysis webinar on YouTube. Trade safe, trade responsibly, and hopefully we'll see you very soon on our next webinar. In the meantime, goodbye.